Hi, I'm Dr. Dave Janda, and please welcome to our Operation Freedom platform, WeThePeopleProcessing.com. You know, are you tired of being threatened to be canceled just because you have a company focused on liberty and freedom? Well, worry no more, folks. WeThePeopleProcessing.com is your go-to merchant services, freedom-based company to provide business service payment solutions. We the People Processing provides their clients a cancel culture-free platform which is domestically based. They provide competitive rates, no contracts with next-day funding, a fully vetted and like-minded financial infrastructure, and full support for integrations, implementation, and e-commerce efforts. Bottom line, WeThePeopleProcessing.com focuses on defending your company's free market growth, values, and future. Check them out at www.WeThePeopleProcessing.com. Once you're on the site, enter in password Operation Freedom or call 855-499-2024. That's WeThePeopleProcessing.com. Then, when on the website, enter Operation Freedom as your password or call 855-499-2024. This show has been in existence since October 2010. At a very similar time frame, my next guest started his platform, tfmetalsreport.com. Outstanding site, outstanding community. I'm a proud paid subscriber to tfmetalsreport.com, led by the great Craig Hemke. I encourage you to do the same. It is a phenomenal information analysis-based site as it relates to your financial freedom and economic well-being. Craig dissects current events, dissects economic issues, and does so in a means so that you can apply it to what's happening in financial markets around the world. Craig was what he described himself as a licensed security professional for nearly 20 years, and then became disgruntled by the fraud known as financial services. He then retired to a career as a serial entrepreneur back in 2008, and all of us benefit from his wisdom on a daily basis at tfmetalsreport.com. It's my honor and pleasure to welcome back our friend, Craig Hemke. Craig, welcome back to the Operation Freedom platform.
Hi, Doc. You got one thing wrong. It is my honor and my pleasure, my friend.
Well, that's very kind. So, Craig, I was driving on the yesterday, and I was listening, of course, to Wham Talk 1600. And we have the Fox News breaks at the half hour and the top of the hour, which I'm frankly not very pleased about, but, you know, what can I do? And they were talking about the fantastic job numbers that were reported on Friday. It was predicted that there would be 155,000 jobs created in the month of January, but shockingly, there were 467,000 jobs created, which is, all the doomsayers about the stagflation and employment. But Craig, educate our listeners about what the real number was.
Well, we don't know what the real number is, Doc. That's what's always so embarrassing about that report that comes out every month. There are other sources that do their own surveys that suggest a huge loss of jobs. We can also track the payroll tax revenue to get some idea of how many people are actually working. But the lunacy of the monthly jobs report, as they call it, is that it comes out on, what was it, Friday the 4th? Yeah.
Yes.
Right? So, and that next month, Doc, it's coming out on the 1st.
Oh.
So you're supposed to believe that these, government bean counters and bureaucrats are giving you an accurate assessment of how many jobs were added or not added over the previous month when the month has only been over for a couple of days. It is nothing but statistical gobbledygook. with guesses based upon, we know over the last 40 Januaries that on average there were this many jobs that were added and this many businesses that were started and this many businesses went out of business, and that means X amount of jobs. And it's just nonsense. But it's all part. It's like CPI, the Consumer Price Index measurement for inflation. All of these numbers are crafted specifically to promote a narrative that the U.S. still has a growing, vibrant economy, and that inflation, even though it's gone up in the last couple of years, is still relatively low. So therefore, investors around the world should have confidence not only in the U.S. Treasury market and bidding up Treasury notes and bonds so that interest rates stay low, but also confidence in the dollar, because the dollar, as you and I have discussed, has been what's called the world's reserve currency for trade since after World War II. That is a mantle that obviously we've held now for almost 80 years, but that's not something that has always been that way, and it's not something that will always be that way. But data like the jobs report are all designed to keep the plate spinning for as long as possible in terms of pumping up or propping up the view of the U.S. economy.
Craig, Zero Hedge looked at this as well, and they said when you add in, it appears that this month they threw seasonal adjustments in it, COVID adjustments to jobs, adding jobs, and population control adjustments. And if you actually take all those adjustments out, as opposed to a gain of 467,000 jobs, they calculated that there was actually a loss of 2.8 million jobs.
Yeah, I saw some stuff, Doc, on Thursday, the day before this jobs data came out, from Google payroll survey and some census, some kind of survey, that were suggesting 3.8 to 4.8 million jobs lost. So those numbers are out there. And in fact, and I'm sure you saw this, over the course of the week last week, even Jen Psaki and the rest of the White House crew were out there kind of plowing the field to get the expectations as low as possible, because even they knew that it was going to be a disaster. And then suddenly here comes this magically nice number, and the stock market gets popped up, and and everybody cheers and says, "Hooray! Isn't this great? Best jobs market that we've seen in decades," or whatever they're trying to claim. And again, it's just not a Democrat issue. These things have gone on during Republican administrations as well. This is a Washington elitist, monetary elitist scheme, and this last Friday was just the latest edition.
Well, and Craig, we're now $30+ trillion in debt.
Mm-hmm.
They're talking, of course, the Fed officials. Well, we're going to, I don't know. The question is, are we going to raise rates 5, 6, 7, 8 times? Craig, one of the issues you have brought up in the past is they can't afford to raise rates when you're $30 trillion in debt, because, well, when you start turning over those bonds at a higher interest rate, it's just going to make things infinitely worse.
Correct. And again, this is one of those things that everybody knows. I mean, anybody can do this math. It's not like you and I have invented the wheel, right? But this doesn't get discussed. This is in polite company on CNBC or Bloomberg. Your stockbroker won't tell you this either, obviously, because, oh, no, we just want to have the stock market go up and everybody's happy. Again, this is just simple math. You got $30 trillion in debt, with paying an average level of interest of something like 1.6% now. You get a line item on your budget of $480 billion in debt service costs. So if, and these claims that, oh, yes, the Fed's going to hike 8 times and the yield on the short-term securities is going to go up, to 3%. Okay. So now all of a sudden you're going to be paying $900 billion to maybe $1 trillion a year, just in interest alone. Okay. Mm-hmm. What is the tax revenue at this point? And that's not even $3 trillion, $2.5 trillion.
Mm-hmm. I believe it is.
Pay 40% of that just to service the debt. And Dave, that's just the simplest metric that we can lay out for people. How about not just on debt service costs, state level, municipal level, corporate level, the high yield bond market. You think of, the increased cost to service all of the debt that's already out there if interest rates go up. But then one more, Doc. The Fed, through these policies of zero interest rates, has pushed investors, not just you and I, like institutions, pension funds, endowments, insurance companies, these places that would normally be very conservative and cautious investors. Well, when interest rates are at 1 or 2%, they go reaching for yield, reaching for return because they've got investment goals they've got to make. And so now all of these, again, pick a pension fund or an insurance company or whatever, that has this massive portfolio that is subject to this risk if interest rates go up. And all of a sudden, you might be still earning 2% on the bonds that you own, but now your bonds are down 10% in value because interest rates have gone up so much. There's a multifaceted problem that, again, nobody will discuss. You're not going to hear, CNBC have some kind of roundtable discussion about how, I don't think that. No. They just keep parading these analysts out there that try to say that the Fed's going to hike rates 7 times this year. Come on. They might take a stab at it, like they did in the period 15 through 2018, try to gradually let rates rise, and then eventually get a point where it all starts to break down like it did in the fourth quarter of 2018. Powell pivoted, is what they call it back then, and he'll pivot again because, again, once you're down this path of quantitative easing and zero interest rates, there's really no turning back, and we're about to get another lesson in that in the months ahead.
So let's play this out in the months ahead, Craig. Let's do a Craig Hemke survey. Where do you think we're going in the financial markets? Where are we going in the precious metals markets?
Well, we can start with the stock market, Doc. Just for people that remember how this played out, the Fed coming out of the first quantitative easing plan was going to be a one-off. It was never going to happen again. Bernanke went in front of Congress and said, "Oh no, we're not monetizing the debt," even though they were, and that their balance sheet would go back to normal, and that the interest rates go back to normal. And it never happened. They played this game again then, from about 13 or 14 through 2018, where they tried to let their balance sheet run off a little bit and interest rates go up. Beginning the fourth quarter of 2018, and this is what it kind of looks like now, the stock market had been rising steadily, just a continual rise, which is what it did all of last year as well. And then it rolled over and fell about 10% in October of 2018 before kind of going sideways through about back half of October and most of November, because we'd reached this kind of breaking point where the interest on the 10-year note was over 3%, and we just, again, gotten to this point where that was as far as they could take it. As December began, though, the stock market fell another 10% between about the 1st of December and Christmas Eve. So now it's down a full 20%. And this is what people then now call the Powell pivot. As we entered 2019, everybody, all these same bank economists that are today saying 5, 6 rate hikes, we're saying 4, 5, 6 rate hikes in 2019. It didn't happen because this Powell pivot. And we're getting to that point again. I think the stock market chart looks a lot like it did this quarter versus that fourth quarter of 2018. So I wouldn't be surprised if at some point we get another drawdown of another 10%. We bounced a little bit, I guess. It might be more like 15 now. And that'll be the point where Powell has to choose. They can't let the stock market crash for many of the same reasons that we discussed a moment ago. And they'll choose and they'll decide, okay, we can't let rates go any higher. And then all of a sudden they'll start cutting again and QE will start again as well. So I would imagine for people with stock market investments, 401k plans, things like that, this quarter may still get rather sticky for them, especially as we get into March, maybe even around the corner into April. But it will soon become clear that the economy can't tolerate a falling stock market and certainly can't tolerate higher interest rates. And eventually Powell will pivot again, and then it'll be probably off to the races, and the stock market will start performing well again.
And what about precious metals?
Well, Doc, in the past, this has been a time whenever the Fed is revealed to be the charlatans that they are, people flock to again, not gold. You and I buy gold, and people that are interested in buying actual gold, you've got those wonderful sponsors that work with. They can call them up and get some actual gold shipped to them this week. But what moves price is people's demand in gold exposure, these derivatives like futures contracts and ETFs and the like. So that demand goes up in these periods of time when the Fed is revealed, and people go, wow, they really are kind of full of garbage, aren't they? I referenced earlier, the first QE plan came out in March of 2009 in response to the great financial crisis. And it was supposed to be a one-off. It was like $700 billion. Bernanke lied to everybody and said he wasn't monetizing. Wait, you're buying treasuries with freshly created cash. How is that not monetizing the debt? But you know how they play with the words. Right. As we got into 2010, everybody was told that was a one-off, it was a done deal, never going to happen again. Well, by November 2010, here came QE2, another $600 billion. As that was figured out, beginning in the summer of 2010 through the summer of 2011, metals prices skyrocketed as the Fed's being revealed for being liars, right, and posers. Gold and silver goes from 18 to whatever it went to, 48. Gold went from about 1,000 to up to 1,900. So those are pretty significant moves over the course of 15 months. Fast forward to this last period I was just telling you about, where Powell had to pivot in December of 18. Everybody thinks he's going to be hiking in 19. No. They start moving toward easing and actually start cutting rates in June of 19. Okay, well, let's start there. Coming out of 2018, gold was down again around $1,200. And by the time we got to August of 2020 with the COVID response and all the other stuff that they did on top of just simply cutting rates, what gold went from a darn near doubled, really. And silver went up as well from about 14 to 28. So it's in these periods where, everybody's bought the lie, hook, line, and sinker, that, the Fed is going to tighten and they're going to normalize this and normalize that. And when everybody, you get these periods where everybody in the world figures out that, wait a second, they've been lying the whole time, that you get this huge surge in prices. And I think you can clearly see that. It's not going to start like next week, probably. But I sure wouldn't be surprised if by the time we get to, the fall of 2023, the summer of 2023, we're probably talking $2,700 gold and $40-some-odd silver at a minimum. Just because, again, just the curtain is pulled back, and the wizard is revealed to be just this old man, who's pulling chains and blowing smoke. And you're about to see that again. It's going to be revealed to everybody again soon.
Folks, we're speaking with Craig Hemke from tfmetalsreport.com. And then we have this, Craig. IMF, World Bank, and 10 countries held an alarming simulation of global financial system collapse. Yeah. This is from Zero Hedge. The report described that Israel led a 10 country simulation of a major cyber attack on the global financial system in an attempt to increase cooperation that could help to minimize any potential damage to financial markets and banks. Oh, yeah, okay. It was centered on a catastrophic scenario in which hackers were 10 steps ahead of us, end quote, according to one official who took part. Craig, call me, paranoid, but this rings like that whole Event 201 that they did in October 2019 before the pandemic, where they were talking about a pathogen that gets released and all of a sudden there are problems. Now we're having this by the same players that brought us that.
Dave, my brother from another mother, you're asking me that question. I'm like, what was that called? And I was thinking Agenda 21. I was like, no, that's not right. Because I was thinking the same thing as you're telling me that.
Yeah.
I mean, they did that whole scheme with the Gates Foundation, everybody else, and they game planned how they needed to respond to social media and all the stuff that you're seeing today, the censorship on social media, and God forbid you offer any type of alternative idea like treating COVID early rather than just sending people home with Tylenol until they get so sick that they can come crawling into the emergency room. Oh, God, you can't even talk about that, right?
No.
But that's exactly, that whole thing was laid out. What was that thing called again, Dave? What was that? Something 21.
Event 201.
You still there?
Yeah, Event 201.
Oh, Event 201. That's what it was. Sorry about that. So anyway, yeah. And so now all of a sudden, the central banks are talking about this massive cyber attack. And if you listen to just their individual little press conferences, Powell has talked about this. The Countess of the Dark, Christine Lagarde, has talked about this. Andrew Bailey over there in Bank of England, he's talked about this. Now, either it's just on their minds, or they're all kind of plowing the same road, plowing the same field, aren't they?
Yeah.
Again, maybe it's just coincidence, Dave, and you're just a kook. But, I don't think you are, Dave. I think you're pretty smart at analyzing and connecting dots and paying attention. To think that there is, outside of what? Some EMP, massive solar flare that fries every bit of electronics, to think that the central bankers would be caught flat-footed by a, bunch of teenagers hacking into their computers and destroying the finance. Come on, man. That's just silly. But again, it seems as if they're plowing the field and planting those seeds, doesn't it?
That it does. So one way people can get ahead of this is being educated and empowered, which brings me to tfmetalsreport.com. Educate our listeners on your community and your fantastic platform.
Well, Dave, you're so kind. It is really, it is a remarkable place, and I say that even though it's like my business. But we've got people from around the world of all different political stripes, and it's unique in a couple of ways. And that what those folks add to my site is of great value, because who can keep track of everything, right? And so the interaction among members is unique. And it's also unique just simply because we all treat each other with respect. It's not like, like you go on Twitter where it just becomes name calling and, ad hominem attacks and all this kind of stuff. We're all in the same boat. You and I are in the same boat, Dave. A lot of people, everybody listening to us is in the same boat, whether you realize it or not. This monetary system, not only the signs there like we just discussed, the math is the math, man. The monetary system is in a terminal phase. And what I mean by that is the system is based on debt. All currency is based on debt. And you can, for a while, you can manage that by issuing more debt, which makes more currency, which gives you some growth, and the thing kind of somehow stumbles along. But as you get toward the terminal phase, the exponential growth of the debt far outweighs how much you can grow your money supply or grow your economy. Right now, they're trying to keep it up just by growing the money supply, and you can see the impact of that in all this inflation and stagflation that we're now getting. That's not going away either, Doc, no matter how much they try to jack up interest rates over the next 6 months. This is all part of that terminal phase, and the only preparation that anyone can make is to educate yourself so that you're ready for this. So you're not caught flat-footed. You don't want to be on the hurricane evacuation route as the thing's coming ashore. You want to be prepared and ready to roll well in advance. And so that's what we try to do at TF Metals Report. We know that there's a mathematical certainty that this is going to turn out this way. And so rather than get all hysterical thinking it might be this way tomorrow, we all try to kind of help each other out in preparation for these events.
tfmetalsreport.com. Craig, in our last minute here, when we're in 2023 and we look back at 2022, what do you think is going to be the biggest surprise in the financial landscape that occurred in 2022?
Probably the stock market ends up higher is the first thing that comes to mind, because the Fed won't have hiked rates. And a lot of times, you can just look around the planet even right now. The biggest nominal gains in equities often come during hyperinflationary periods.